Your DeFi strategy sucks, and today in this video, I'm going to break down exactly why. But the first thing I want to mention is your DeFi strategy definitely sucks if you don't have one. And that's probably a lot of you guys that are watching this video. Maybe you have some sort of a process that you go to where you're like, okay, I go find my liquidity pools here, I deploy on these exchanges, I rebalance here, right? And you just kind of repeat that process. But truth be told, you have to adapt your process to different market circumstances. And that right there is exactly what a strategy is. So let's dive into it. Now we have to understand that the markets are bleeding and we have to accept our fate. If we can't do that and we can't accept the current situation that we are in, we are not going to be able to achieve our goals in DeFi. That's also a second part about the strategy. We have to set our goals. So we're going to start with those two and move forward. Now guys, the markets today alone, and I'm recording this on Sunday, this video is going up on Monday. Guys, Bitcoin is down 5.9% at 78,000 bucks. Ethereum sitting under $1,600, down 12.9% on the day. If we dive into altcoins, some stuff like Link is down 13%, stuff like AVAX is down 10%, Sui is down 14%. We continue down this list. We have some other altcoins like Hyperliquid down 15%, Uni down 13%, Ondo is down 10%, and we can go on and on and on this list, but most altcoins that actually have a use case are down 15%. And I want to tell you guys that right now, crypto has not fundamentally changed. Fundamentally, crypto has never been better, but when we look at the prices and we look at the sentiment, it has never been worse. And the reason why is because the United States economy is affecting the market. And again, today, I don't really want to dive into the market and why it's doing what it's doing, but if you guys do want a video like that, drop a like, subscribe, notifications turned on, and also let me know down below in the comment section that you guys do want to see a video on the market and why it's doing what it's doing basically. Today, I want to talk about two things. Number one is asset accumulation, and number two is stability basically, right? Because we have to choose one. Do we want asset accumulation or do we want stability in our portfolio? Once we choose one, we can start to put a strategy in place. But let's break down the difference between these two real quick. Asset accumulation. This is going to be when you're not worried about price fluctuations. Now, why would you not be worried about price fluctuations? This would be if you have a long-term mindset. If you're investing now and you're investing not for the next 6 months, not for the next 12 months, but maybe for the next 18 months or the next 24 months or the next couple years, right? Point is, you're not worried about price fluctuations as much as you are worried about actual asset numbers. So that means 10 Ethereum to 12 Ethereum to 14 Ethereum, even if it comes at the cost of your $10,000 going to, let's just say $8,000, going to $6,000, and so on and so forth. As long as you're accumulating more Ethereums is what you are focused on basically. So again, this is for people that are bullish on the crypto market. In the long term, maybe in the short term, people that are bullish and think that the prices are going to go up during their investment horizon, they are asset accumulators. They want to accumulate more assets. Now, as an asset accumulator, as somebody that wants to accumulate more Ethereums, more Bitcoins, more AVAXs, more Links, Ondos, whatever asset it is, basically, you just want to stack your bag over time. Well, guess what? Your positions are going to look like this. This is an Ethereum to TAL position. It is down 13.5%. The overall strategy is down 30% overall. I invested roughly $30,000 or so. I now have 18,000 bucks or so, and I've taken out a little bit of earnings. But again, your goal here is to not have a profit on the dollars, but to have a profit compared to holding in the market. So when we look at this, what this tells us is, hey, if we stuck our money in a ratio of 70% TAO and 30% Ethereum, we gotta have $18,428. But with our earnings, we have more than that. We have nearly $19,000. We have a profit compared to holding in that ratio. We have a profit compared to holding in a 50-50 ratio. We have a profit compared to if we stuck our entire deposit of nearly $22,000 in TAO. We nearly have a profit, nearly, just down $6.82 compared to this metric, but nearly a profit compared to if we held all of our money in Ethereum. So point is, your goal here is to profit against holding in the market. Now over here with sold to render, here's another example. Now this is on Crystal, so it doesn't give us as many metrics, but you could see our deposits were 21 grand. With the fees at current price, we have $16,520. Realistically, this is doing a 70% APR. I don't know where they get this APR number from, but we are profiting $1,150 compared to holding in the market. So even though we're down on a dollar in, dollar out, we have more assets, more souls, more renders. If we take a look over at Ethereum to TAO, we have more Ethereums, more TAOs basically. basically. So we're an asset accumulator right here, and we are beating if we held our money in the market, which means that this strategy is actually giving us a check mark. We are beating, holding in the market, and we are doing well. Now, if we're taking a look at a stability approach with these positions, well, guess what? These positions suck, right? We're going to get a big red X on these positions simply because these things are losing money. They are bleeding money. Simple as that. They are down 2,900. They are down 4,500, right? They are bleeding dollars. But again, if we're an asset accumulator, not worried about dollars, worried about assets. If we're a stability approach, we're worried more about keeping our money and keeping our capital preserved, which does come at the cost of not having as much upside exposure. So when we do see those crazy gains with, Ethereum, Bitcoin eventually, if Ethereum goes to $7,500, well, a lot of us that are investing at $1,600 are going to see crazy growth. As a stability investor, you're not going to see that growth, but rather you're just going to see the consistent, maybe 30 to 50% APR that you get on your portfolio. So again, if you're a stability investor, you're trying to preserve capital. You don't want that upside exposure. You don't want that downside exposure. Maybe you're bearish on the crypto market, or perhaps you're not bearish on crypto. It's just you don't want exposure to the price volatility. I know plenty of stability investors. I work with plenty of stability investors that think that this technology that we see right now is amazing, right? It's great. It's doing amazing. They think that decentralized finance is going to be the future. But the thing is, they don't want exposure to Bitcoin. They don't want exposure to Ethereum. So they love the tech, but right now they know that the assets are too volatile to include in their portfolio. So what are they doing? They're taking advantage of the high yields without taking market exposure. They're hedging out their market exposure. Their goal right here is to profit on a dollar in, dollar out basis. And what that means is if they put $1 in, they want to have more than $1 on that dollar, basically. So this strategy right here, where they're accumulating more assets and profiting versus HODL, this means nothing to them, simply because they are losing money at the end of the day. They do not want the ability for their portfolio to decline this much in value. So again, this could be positions like I'm running over here with USDT on Fluid Dex, which is by Instadap. I have 167 in Paul rewards, which at current price is about $30. I entered this position about a week and a half ago or so with about $11,000. So this is earning me about a 7.8% APR just by lending out USDT. Simple as that. No catch. And this is a reputable platform. And there's plenty of other opportunities on a couple other networks with Fluid Dex. But point is, it's as simple as that. This is what stability investors are investing into. But again, they understand that, hey, I'm taking a little bit extra risk to get 7.8%, when in reality, I could go and lock up a CD, get 4.5% right now, right? And truth be told, we're not going to have those rates for a while because interest rates will continue to go down, hopefully. But point is, they're going to invest into delta neutral strategies as well, hedged positions that might have a little bit more risk associated with them, but they're going to have substantially more return associated with them. So if I were to show you one of those positions, it's going to be this Fartcoin to Sol position right here. And you're probably going to say, hey, Jake, no stability investor is ever going to go anywhere near Fartcoin. And I'm here to tell you it's actually the complete opposite. They are flocking to Fartcoin and flocking to Sol, not because it's doing a 330% APR right here, because it is doing a 330% APR, but also because they can hedge out their market exposure. You could see I'm beating HODL on this position. It's amazing. It's great. I have $6 in divergence loss. I'm down money, and that's not my goal because this position right here is a stability strategy. I include both of these strategies, both asset accumulation and stability in my portfolio. Now I started with $2,000 over here on Radium Perpetuals, and I currently have $31.25, which means that I'm at about a $1,125 profit on my shorts. And I'm at an $833 loss on my longs. When we do the math, I come out to an overall $292 profit on this position that I've been running on Sol to Fartcoin. Why? The LP position is down, yes, but my shorts are up. My shorts are making up for the loss on the long, which would be the LP position. Thing is, the long is still producing crazy returns like 330% APR. Now I'm using leverage over here on Radium. I'm using 3x leverage, which is completely fine because it's safe because, well, guess what? I have a long position, so I can avoid getting liquidated. Now I've been in this position for about 11 days, and if we divide that 292 by 11, well, guess what? We come out to about $26 a day. If we multiply that by 365, we come out to $9,689 a year. Now guess what? I deployed $6,200 over here, and over on Radium I deployed $2,000, which equals a total of $8,200. So if we divide that number by $8,200, that would give us an APR, which is 118%. So 118% APR on a hedged position, on a stability strategy. That is exactly why stability investors are flocking over to Fartcoin and other meme coins, right? Now, there's a lot of management with those hedge positions because guess what? Your ratios are all over the place. You have to always add a little bit of the short to Fartcoin, remove a little bit of the short from Sol, or vice versa, basically. But point is, you're still profiting on a dollar in, dollar out basis. So as a DeFi investor, you need to choose your strategy and you need to benchmark to that strategy. It makes absolutely no sense for a stability investor to benchmark compared to holding the market. Same reason why it makes no sense for an asset accumulation investor to benchmark against a dollar in, dollar out basis, right? So choose your strategy and don't let the red numbers, if you're an asset accumulation investor, affect you. Or if you're a stability investor, don't let that versus HODL affect you, right? Let that dollar in, dollar out affect you. And again, there are two separate systems to building out these approaches, right? With an asset accumulation one, you're going to want to find highly correlated assets, right? And then you're going to want to make sure that those are earning decent APRs because you're going to want those APRs to outweigh any divergence loss you might have. And then, of course, you're going to want to rebalance your positions strategically at good times. And you're going to want to make sure that these are all coming together to equal a profit compared to holding in the market. Whereas as a stability investor, it's completely different, right? You're going to want to have high APRs because, of course, you want to make sure that the APRs outweigh any loss on the hedge, basically, because you need to rebalance and you are going to be locking in some divergence loss. You are going to be looking for low divergence loss, but it doesn't matter as much simply because, well, guess what? You're hedging. And of course, you're going to want to be looking for assets that can be hedged. That's the most important piece of the puzzle, basically, assets that can be hedged. And then these three come together, basically, to create a profit on a dollar in, dollar out basis. So again, guys, you need to choose which strategy fits you. And if you guys do want help choosing or even implementing on one of these strategies, feel free to let us know. There's a link to our website right below this video. You can fill out a quick little form, get on the phone with our team, see if it's a good fit for us and then a good fit for you. And then we'll recommend one of our programs to you if it is a good fit for both of us. There's no pressure whatsoever there, but that's a resource if you need it. Otherwise, guys, stay tuned, drop a like, subscribe, notifications turned on, because I'm going to have some more content coming on how you can build out an asset accumulation portfolio, and then also some more content coming on how you can build out a stability portfolio. I hope to see you guys in the next video, and peace out.